What's up, everybody? This is Sunko, the Korean bro. Today is 2023, March 12th. Mm. Today, I'm going to read a stock market article. And recently, we have interesting news, right? Mm. The news that I'm about to read is about SVB collapse, and it was a mm, mm, big issue because recently. Mm, because of high interest rate and like high inflation, a lot of companies are struggling. And that, uh, with that being said, mm, this company uh, tragically could not avoid uh, its destiny. Well, before we dive into it, I want to briefly go over some other articles first, and then we'll read about it at the end. So let's see. Trade growth stocks with more potential than any cryptocurrency. Let's see. Down nearly 60%, this growth stock sell off looks like a buying opportunity. You can't control a bear market, but you can control what you can do about it, okay? Okay, for only the fifth time in 153 years, this leading economy. Well, okay, by hold, the stock decade of passive one breath big warning that every investor should have. He one group. Mm, okay, one by one, I'll be reading it, okay? Drury growth stocks with more potential than any cryptocurrency. Teladoc recorded another impairment charge, but these paper losses shouldn't keep investors at bay. Teladoc Health, okay. Let's look at price of Teladoc Health. Teladoc Health. Okay. Mm-hmm. Etsy may not be growing at its pandemic pace, but its trajectory from pre-pandemic level is strong. Airbnb is reporting record cash flows, which may provide a safe harbor in choppy economic waters. Okay, let's see. Taido has taken investors for a wild ride over the past year. Yes. It has emerged from the heightened growth period of the pandemic and seems to be settling into a more moderate, mature era of its growth story. Nonetheless, growth remains strong, not just on year-over-year basis, but from pre-pandemic levels. And those recent net losses that have caused some investors to head for hills are more easily explained. They might appear at first glance. Looking at Teladoc's financial performance in 2022, the company delivered revenue of $2.4 billion, representing a nearly 20% increase from 2021. That was also an increase of 335% from 2019, before the pandemic drove a heightened period of teledoc adoption by medical providers and consumers. While the company reported a net loss of $13.7 billion in 2022, that was almost completely derived from a series of non-cash impairment charges attached to its efforts to write down the value of its prior Livongo acquisition. So even as those figures are painful to see, that net loss wasn't related to an underlying deficiency or operational decline from Teladoc's business. So here it says net loss had nothing to do with their operating uh, operation cost. It had more to do with acquisition cost, which was something that had to be done. Hmm. Okay. At the same time, adoption across Telos' core range of virtual care services from chronic care to mental health care to primary care continues to rise. Hmm. Adoption across Telos' core range of virtual care services from chronic care to mental health care to primary care. In the final quarter of 2022 alone, its teletherapy segment better help deliver revenue of $277 million, representing a 30% increase mm, compared to the final quarter of 2021. Meanwhile, Toyota closed out 2022 with more than 83 million paid members in the US, and the cohort of users enrolled in at least one of its chronic care services jumped 10% year over year in the final quarter of 2022. This isn't because this isn't a business in its waning days, but rather one that is continuing to prove its mettle as a leader in the present and future of the telehealth industry with a broad and growing spectrum of virtual care services. For forward-thinking investors, this could provide a notable opportunity to scoop up shares at a discount to build or add to a multi-year buy and hold position. Hmm. Okay, let's read another one. Two stocks under $30 to buy and hold for the next decade. Tel is looking to improve its bottom line while benefiting from the growth of the telemedicine industry. Pinterest's growing user base, increasing engagement, and e-commerce opportunities paint a bright picture. There's no need to break the bank or wipe out one's savings to start investing in stocks. Tell them. Uh, is finding out the hard way that growth at all costs isn't as appealing to investors anymore. Last year, the company recorded a massive net loss of $13.7 billion, about $13.4 billion of which was due to impairment charges linked to its 2020 acquisition of Livongo Health. So although Telado's top line increased by a solid 18% year over year, to $2.4 billion. Its shares were southbound for most of 2022. Teladoc shares are currently worth about $25, even after rising by 7% this year. This good news is that Teladoc is looking to prioritize the bottom line. Management is working on cutting costs, notably by laying off 6% of its workforce during the first quarter. Among other initiatives, achieving greater efficiency will lead to stronger growth for the company's earnings before interest, taxes, depreciation, and amortization, at least if we go by the company's guidance for the fiscal year 2023. Toyota expects revenue growth between 6 and 11% year over year for 2023, but with EBITDA growth between 12% and 32%, putting aside the impairment charges which won't last forever. Toyota isn't that far away from profitability. If it can increase a bit at the predicted pace this year and the next, green on the bottom line will be in sight, if not reality by the end of 2025. While slowing top line growth rates aren't ideal, let's look at the big picture. Toyota's popularity skyrocketed during the pandemic, but things are cooling off now. That's a familiar story for many companies, including some very prominent ones. The good news for Toyota is that there is plenty of room to grow in the telemedicine industry, considering how convenient virtual care services are. Some estimate project a compound annual growth rate of 24% through 2030. Some of Telado's segments will continue rising. The company's virtual therapy service, BetterHelp, has been on fire. According to the company, is now a more than $1 billion business and has more than doubled in the past few years. But management thinks the virtual therapy market remains under penetrated. Teladoc's data and analytics-based health coaching for diabetes patients through Revival Health also looks promising. Hmm. With a modest forward price sales ratio of 1.6, Teladoc looks reasonably valued too. Expect the company's revenues growth to stabilize while it becomes profitable in the next 5 years. And beyond that, Teladoc will continue to ride the fast-growing telemedicine industry and deliver solid returns over the next decade. Okay. And what else was it? LT, okay. Is another former pandemic favorite. The investors seem slightly unsure what to make of against the backdrop of the current volatile investing landscape. There's no denying that if a recession comes, consumers who are already trying to cut costs where possible hmm, could significantly scale back spending. This would inevitably affect any business with exposure to discretionary consumer spending, and that is no exception. It's because we had Corona, and because we had a high interest rate, people were really um, hesitant in terms of spending some money on goods. So on the flip side, Etsy remains a platform known for its collection of unique vintage and handmade items, the types of products the consumer may be more apt to purchase in a high inflation environment rather than brand new or name brand items from large retailers. Furthermore, even if a recession does come, several quarters of turbulent economic waters don't negate the potential of Etsy's business, its position within the broader e-commerce industry. Management estimate the Etsy.com platform alone operates within a $2 trillion addressable market. At the same time, Etsy has few direct competitors and even fewer that operate or at least at its level or scale. In the fourth quarter of 2022, Etsy delivered revenue of $87 million, up 13% year over year, while reporting profits of $110 million, and blah, blah, blah. Okay, next. The cloud company continues to grow briskly. With more growth ahead, the sell-off looks like a compelling opportunity. Cloudflare stock price has been under a lot of pressure over the past year. Okay. Cloudflare have been on my watch list for quite some time. I've watched it as shares of the global cloud services provider have tumbled nearly 60% from their peak over the past year. Cloudflare. Okay. During that time, the company's financial results have steadily improved. That recently led me to step off the sidelines and add a few shares of the beaten down growth stock to my portfolio. Here's why I think the sell off looks like a good buying opportunity for long term investors. The numbers are all trending in the right direction. Cloudflare recently reported its fourth quarter and full year results, which were impressive. Revenue surged 42% in the quarter to $274.7 million, while jumping 49% for the year to $975.2 million. They also reported $35.7 million of non-GAAP income from operations last year, an improvement from a net loss of $7 million in 2021. Meanwhile, free cash flow was positive in the fourth quarter at $33.7 million, or 12% of its total revenue. They already company to end the year with a solid balance sheet with nearly $1.7 billion of cash equivalents and securities against $1.4 billion of convertible senior notes. The company's growing scale is helping drive its operating margin higher. Okay. Cloudflare expects its operating margin to continue expanding as it scales. Its long-term model has sales and marketing costs falling to 27% to 29% of revenue, while general and administrative expenses decline to 8 to 10%. That should ultimately enable the company to expand its operating margin above 20%, potentially enabling it to deliver significant earnings and free cash flow growth in the coming years. A vast market opportunity. A big factor driving the company's long term operating model is its belief that it can continue to scale the business. It sees an enormous and growing total addressable market opportunity. As that slide showcases, the company's current product offering positions is it to capitalize on a $125 billion cloud market opportunity. That's up from a $32 billion in 2018, driven by organic market growth and the company's product innovation. Meanwhile, its attempts should continue expanding, driven by organic growth and continued innovation to tap new potential growth areas. The company has multiple ways to tap that large opportunity, including acquire new customers. The company grew its customer count by 16% last year to over 162,000 paying customers. Count by 16% last year to over 162,000 paying customers. Expand relationships with existing customers. The company's dollar-based net retention rate has averaged more than 120% over the past year, showcasing its ability to retain customers and expand those relationships. While, meanwhile, it's quickly growing its large customer groups as it continues expanding those relationships. Dollar-based net retention rate has averaged more than 120% over the past year, showcasing its ability to retain customers and expand those relationships. Meanwhile, it's quickly growing its large customer groups as it continues expanding those relationships. Develop new products. Cloudflare continues to invest in innovation to expand its opportunity set. Extend its serverless platform strategy. The company's unique network increases retention and opens new market opportunities. Despite the uncertain macroeconomic environment, the company expects to continue growing briskly in 2023. It sees total revenue rising to between $1.33 billion and $1.342 billion, or a 37% increase from last year at the midpoint. While higher costs will keep its operating margin at bay this year, earnings will still grow at a healthy clip. Meanwhile, the investment in its network and research and development position the company to continue growing rapidly. Cloudflare stock has lost a lot of altitude over the past year, selling off along with most growth stocks. However, its financial results continue to get better. While it's not cheap by any means, the company's growing scale should allow it to grow into valuation as it capitalizes on the massive opportunity seized ahead in the cloud services market. Thus, it's a much more compelling investment opportunity these days. A lower entry point, okay. I've seen it myself. I researched uh, about Cloudflare. Uh, basically, I can put it this way. They mm, help customers have better access to internet, which means customers can use internet uh, really fast because with CDN service they provide, uh, every time client requests some info from the server, uh, then the nearest server will be activated and will respond to the request that clients make. Um, and they kind of like a temporary server or like a cache server uh, is like located everywhere in the world, and it basically helps clients gain better access to internet. So okay, let's see. Let's go over to the next one. You can't control a bear market, but you can control what you do about it. Investors should start out understanding the bear market happens, and there's no point in getting overly upset by it. Distract yourself during bear markets by focusing on dividends. The best time to prepare for a bear market is actually during bull markets. So much attention. Okay. Counter dividend checks. Create a watch list. Okay. I learned it the hard way, but you don't have to. Bear markets are part of the investing process, and you need to accept that. A way of dealing with them, which I recommend to you, is to stop paying so much attention to the market's gyrations. Focus instead on the dividends you collect from dividend stocks. They'll be far more consistent over time. And prepare for bear markets by making a wish list that will let you turn market downturns into market opportunities. Okay. Even with a tougher economic backdrop, the internet will keep growing, and that will benefit top web services providers. Macro pressures have a coach cast a shadow over the digital ads in the industry. Okay. Cloudflare. Okay, just like what I read. Okay, let's read it one more time. Okay. Oh. The leading provider of web technology, including content delivery network and domain name system services and protection against distributed denial of service attacks. The company's stock trades down approximately 73% from its previous size, but I expect that it will eventually bounce back and go on to deliver strong returns for long-term investors. Despite some mounting headwinds as the year progressed, Cloudflare delivered another period of strong performance with its fourth quarter results. Even with macroeconomic conditions tamping down on demand somewhat, Cloudflare continued to see existing customers increase their spending on services. The web software company recorded a net revenue retention rate of 122% in the period, which means that clients increased their spending by 22% year over year on average. Along with new customer additions, strong net revenue retention helped push quarter fourth revenue up 42% year over year to $274.7 million, and annual revenue up 49% to $975.2 million, and brings the company's annualized revenue run rate to roughly $1.1 billion. With recent fourth quarter earnings call, management reiterated that the company is on track to reach an annualized run rate of $5 billion by the end of 2027. Next, okay, for only the fifth time in 150 years, this leading economy indicator is sending a terrifying warning to Wall Street. Okay. So next. Okay. Hmm. Let's read this one. High inflation has driven interest rate hikes, and that's had a crushing effect on valuation for growth stocks. Even some of the world's best companies are feeling the squeeze of macroeconomic pressures. But long-term investors should be able to score loans by putting their money behind strong category leaders. Let's go about it. First, Amazon has a landing positions in the e-commerce and cloud infrastructure services markets. It's also got a fast-growing digital advertising business and an impressive penchant for innovation. It wouldn't be a stretch to say that it's been one of the most impressive and disruptive businesses of the last 2 decades. But the company's strength haven't been enough to stop Amazon's share price from plummeting from its peak level. Amazon's share price has fallen 46% over the last year. Its stock is off 51% from its high, with guidance for sales should come in between $121 billion and $126 billion in the first quarter. Management midpoint target calls for year-over-year growth of just 6% in the period. Given that the company has managed goal to grow revenue roughly 166% over the last 5 years and 73% over the last decade, it's little wonder that this growth drawdown dampened investors' enthusiasm. With operating costs soaring over last year, uh, due to inflationary pressures on multiple fronts and some missed investments aimed at meeting pandemic-driven demand is now dissipated, it's particularly easy to be down on e-commerce business right now. But the crucial profit-driving Amazon Web Services cloud infrastructure business is facing some growth deceleration, margin contraction as well. While the segment's operating income margin still looks fairly encouraging, given that sales continue to grow at a solid clip. Hmm. Rising expenses are eating into overall profitability. Increases for energy costs and salaries for retaining top talent are tamping down on profits for the cloud business that's key for driving total bottom line performance. But while the company's core e-commerce and cloud business will likely continue to face pressures in the near term, investors shouldn't underestimate Amazon's long-term potential. Next, okay, Amazon Snowflake, Paramount Global, American Express, Neo, Axis, Walt Disney, Alphabet. What is it about Alphabet? Let's read this one. Okay. Fifth stunning growth stock that you will regret not buying on during the Nasdaq bear market dip is Alphabet, the parent company of internet search engine Google. Hmm. Autonomous vehicle company Waymo and streaming platform YouTube. The parent company of internet search Google, autonomous vehicle company Waymo, and streaming platform YouTube. It's like parents of all those companies listed right now. At the moment, advertising weakness is Alphabet's biggest headwind. When the profitability of a recession materializing rises, advertisers pull back on their spending. But this is also a two-sided coin. Even though recessions are inevitable, they're typically short-lived. Buying ad-driven stocks during these short swoons often allows investors to take advantage of long-winded economic expansions. Buying ad-driven stocks during these short swoons often allows investors to take advantage of long-winded economic expansions. Alphabet's competitive advantage isn't going away anytime soon. Either. Since December 2018, data from Global Stats shows that Google has accounted for roughly 91 to 93% of global interest search share. Having a 90 percentage point lead over its next closest competitor allows Google to command a significant pricing power for ad placement. Alphabet's ancillary operating segments provide plenty of promise too. YouTube is the second most visited social platform in the world, with Shorts getting more than 50 billion daily views. Meanwhile, Google Cloud has worked its way up to a 10% share of global cloud infrastructure service spending. Although we have a like a Chat GPT and like other AI based search engine, still including Alphabet, it takes up about 91 to 93% of global internet search share at this point. But we'll never know. We'll never know share in next 2 years or 3 years. But then at this point, currently, it's at 91 to 93%. Okay, let's read this one. SVB collapse could add to China stock investors' anxiety. It's been a really hot issue, right? China stock investors are already disillusioned by Beijing's lower than expected economic growth target for the year, will be further disheartened by the stock collapse of U.S. lender SVB Financial Group, market participants said. China's CSI 300 index dropped 4% last week, while Hong Kong's Hang Seng tumbled 6% as China's moderate GDP growth target of around 5% for 2023 set during the annual session of the rubber stamp parliament dashed hopes for a big stimulus. The market mood cloud would be damped further following Friday's sudden collapse of startup-focused lender SVB, which stirred heated discussion over the weekend in China about its fallout. The SVB failure is a barometer of macro risk, reflecting how asset prices are being impacted by central bank rate hikes. Say one way, hash fund manager at Water Wisdom Asset Management, predicting tougher times for highly leveraged firms with liquid assets. Although the event will unlikely trigger another financial crisis, it could have a negative psychological impact on China's market, he said. SVB's China joint venture with Shanghai Pudong Development Bank said on Saturday that it has a sound corporate structure and an independently operated balance sheet in an apparent effort to pacify local clients. But many Chinese tech startups, especially those with dollar funding, have opened U.S. accounts at SVB. And each one, which a group with several hundred members, has been informed by anxious Chinese clients of SVB seeking to safeguard their interest. a lot of issues are happening lately because of interest rate, right? Anyway, this is it for today. I'm gonna see you tomorrow, okay?